Fish Food Limited is preparing its financial statements for the year ended December 31st, 2020, and it's just obtained an actuarial pension valuation as at its year end. Prior to the actuarial valuation, Fish Food determined, based on the individual components of its annual pension expense, that its estimated defined benefit obligation at December 31st, 2020 was $356,700. The just completed actuarial valuation revealed that the defined benefit obligation is actually $398,000. The difference is due to updated assumptions used in its calculation. Identify the effect that this actuarial valuation will have, if any, on Fish Food's 2020 pension expense, assuming A, that Fish Food reports under IFRS, and B, that Fish Food reports under ASPE. Okay, so what we have here is we have an actuarial valuation. So prior to the actuarial valuation, the defined benefit obligation was $356,700, and after the actuarial valuation, it was $398,000. So the increase in the DBO, defined benefit obligation, is $41,300. So how is this amount going to be reported under IFRS? Well, this change in assumptions under IFRS would record this amount as a remeasurement loss through OCI. IFRS would record the amount through OCI and the defined benefit obligation and the DBO. So the journal entry would be debit OCI as a loss, remeasurement loss, or actuarial loss of $41,300, and the debit, or the credit, sorry, is going to be to the defined benefit obligation, which is also going to increase $41,300. Under ASPE, which is B, ASPE would record the amount through pension expense. There's no OCI under ASPE. Through net income, through pension expense, and the DBO, and increase the DBO. So our entry is going to be under ASPE, it would be debit pension expense, credit the DBO in the pension plan, defined benefit obligation for the same amount, $41,300. So you can see here that IFRS records this actuarial loss through OCI. There's no OCI in ASPE, so it's going to record it directly through the net income through pension expense. It also needs to be disclosed separately. Under ASPE. So ASPE specifically requires any actuarial gains or losses or any remeasurement gains or losses on plan assets to be disclosed separately. The reason IFRS shows it separately in OCI, so it's already clear, whereas because ASPE doesn't have OCI, they require separate disclosure in the financial statements.